With her look ahead, Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower Advisors and a CNBC contributor. Stephanie, great to speak with you. I do want to start with...
Great to see you.
I do want to start with inflation, because we know that really powered the market into the final trading days, into a strong end of the week last week. We get another reading on inflation, PPI, tomorrow. Given some of the Fed speak we're getting so far, walk me through this notion of don't fight the Fed, because it seems like equities have been fighting the Fed a little bit.
Yeah, and it's really great to see you back. Welcome back.
Thank you.
So I think we're still processing the CPI, right, from last week, because on the one hand, it's absolutely quite positive that the core CPI fell month over month, year over year. Owner's equivalent rent fell a little bit more than expected. That was a surprise. Of course, though, we have been getting the prices paid indexes from the PMIs, and that, as you very well know, they're a 6-month leading indicator for CPI. So all that was really good, and I get why the market rallied. The problem is, Morgan, we still have services, which is 73% of core CPI, that remains elevated. So that means that all of the positive surprise on the headline number, on the core CPI number, was all goods related. And that's not a surprise, because we know there's inventory, bloated inventory everywhere, right? And so we've seen a lot of discounting. And that's what makes this week so interesting, because you get the government retail sales report, but then you get 33% of the retail market cap, 50% excluding Amazon, of the retail market cap reporting this week. So we're going to hear about inventories in spades, right? So in addition to that, we get PPI, as you very well know. So it's going to be a wild week. Now, in terms of don't fight the Fed, yeah, because that's always been the case, right? We put an unprecedented amount of liquidity into the system over the last 3 years, and the market's rallied as a result. Now, the market is doing, the fiscal side is doing something different in terms of not putting more money in terms of programs, or not as much at least, and you have a much more hawkish Fed. And so that's really one of the reasons why you don't want to fight the Fed on either side. That being said, if peak inflation is here, I get why the market's rallying, especially because seasonally, this is the strongest part of the year to be invested in the market.
All right. That was a comprehensive answer right there. I wanted to go back to the retail piece of this puzzle, though. Are there certain names, given how many companies are reporting this week, are there certain names that you're watching particularly closely, given this macro conversation that we've kicked off here with that first answer?
Yeah, no, absolutely. And I think in Target, I own Target, and it's been painful, Morgan, for sure. It's down 25% on the year. But this is a show me story. They pre-announced negatively 2 out of the last 3 quarters. Then last quarter, they missed earnings, but they reiterated the second half of the year guidance. And they talked about a comp of 2%, 2 to 3%, which is what they've been doing. They're taking share from some of the weaker players. But on the inventory side, they actually talked about operating margins getting back to that 6% level in the second half of this year. Remember, last quarter, they did 1.3% in an operating margin situation. So did they write down everything? Did they kitchen sink it? And throughout last quarter, I think they did. And I think the valuation at 15 times forward is very attractive, especially when you look at Walmart, which is trading in a low 20 times multiple. And it's it's held up much better than Target, only down 2% on the year.
In terms of these green shoots of a reopening materializing in China, your thoughts on that and what it means for some of the other names that we might see report this week?
Oh, well, I mean, I think that, we're seeing every other day headlines, they're opening, they're closing, they're opening, closing. If you saw last week, you saw when they announced, or the word was that they were going to partially reopen, you saw companies like Nike do really well. You saw companies like Starbucks do really well. I think you're just going to have a lot of overall the discretionary sectors do better than expected. Just some of the other names, though, that are important for this week. TJX is up 19% quarter to date. The expectations are so high, and they are a clear beneficiary of inventories and escalated inventories. But I think we have to be careful. They have very tough comps year over year in Marmaxx as well as in home goods. And also, they've talked about price increases that they've been putting in place and want to see if we get any pushback.